All right, let's get stuck into it. So this is a two-part webinar. The second part, I will remind you at the end, and you are automatically enrolled for it, is next Thursday at 1 p.m. Tonight, we're going to cover a few things. I'll go into that. And then what we're going to do is we're going to try and implement what we learned tonight next Thursday. So we're going to do a live trading session, very similar to the type of trading session that we do for our clients on a daily basis from 12 to 1 every day. So we're going to try and simulate that a little bit. We're not going to go into an excessive amount of detail because the vast majority of our clients, if not all of them, I would say are highly educated when it comes to trading. And so we can work at a pace which is probably much faster than what we're going to display next Thursday. Today, though, should give you a bit of a bump, I would say, hopefully in your knowledge. I'm going to keep things fairly basic. I don't know what level of experience you all have. I'm sure there's some of you who, again, are very in the early stages of your beginnings, in that research phase, not exactly sure what it is that you need to look at. You're perhaps searching for a company to do an education course with or learn from or get some support from. And then I'm sure there's people on the complete other end of the spectrum who have plenty of experience and maybe even been doing it longer than I have. Could tell me what for, right? So hopefully, regardless of your level of experience, you grab something positive from tonight, you learn something, and you're able to join us for next Thursday where we can really follow through and round everything out. All right. Let's get stuck into it. You might be wondering who I am and who we are. First of all, the company I work for and I help run is Traders Circle. Traders Circle has been around since 2005. So I would say quite a long time, all things considered for a small business. We've always been a small business. There's only about 8 of us in the office. If you have a look around behind me, obviously the desks are empty at 7 o'clock at night. We've been kind of working from home as well. But a fairly small, really nice office located in the heart of Melbourne. We're on Little Flinders. So we're nice and local. And because we're small, obviously, in order to compete with the other major providers out there, our focus is really on providing exceptional service. And that's how I think a lot of small businesses compete against monopolies, which is where a lot of the world's going now. And so really what Traders Circle is about is teaching you, right? If you need to be taught, and in fairness, there's probably a lot of people who do, and then supporting you as you learn, and then really holding your hand as you transition to live trading. And then from there, really what our business is about is supporting you as you trade. So we're traders. I'm a trader, obviously. The other advisors sitting on the trading desks are traders. The majority of people in this business, even the marketer, is a trader, of course. What we want to do is we just want to support you in your trading. So you can call us up, and I'll touch on this at the end. So if you're joining us late, then all good. But what we want to do is essentially be a soundboard for you sometimes. You might call up and say, this is a trade that I'm looking at. What do you think? These are the reasons why. What type of strategy could I do? How can I take advantage of my view? You might call up and just say, hey, I'm on the road. I haven't had time to look at the market. If you've got any trade ideas, or can you just check my positions for me? So we're a full service desk, essentially. We don't provide personal advice. We only provide general advice, and I'll go into that in a moment. But yeah, the idea is to have someone kind of backing you as you trade. Now, you can use that as much as you want or as little as you want. Some people might call us every day. There's some clients, and you know who you are if you're listening, who call us several times a day. And you know what's funny is that they're the ones who are the most successful. That being said, we've had clients we've had for many years who might call us up every now and then, right, when they need the help, depending on the type of trading that they're doing, if it's short, medium, or long term, often. Emerald Financial, on the other hand, you can see the other logo there. It's like a sister company. See, Traders Circle focuses more on trading, but Emerald Financial focuses more on medium to long-term capital gains. So it's about providing stock recommendations for both Australia and the US. Emerald Equities is about providing resources so that you can go out there and just manage your portfolio, because let's be honest, not everyone is in the mood for short-term trading. They don't have the risk tolerance for it. It's just not something that they want to do. It's not the right time of life for them. They don't have the capital for it. I mean, there's all these reasons, right? And so we've got Emerald Financial provides a way to still be involved in the market and make educated decisions, but in much lower touch, so that you can use the stock screener and our state-of-the-art scoring system in order to find appropriate trades, basically, or sorry, appropriate investments, if we're going to use perhaps a more appropriate word. So between the two companies, we think we can basically cover a lot of ground. And if you're looking for that kind of small business, personable approach, then this, I think, we're the company for you. Now, as I mentioned earlier, we don't provide personal advice. So the only advice that we contain, including the presentation tonight, is general advice only. And what that means is that you must decide whether or not the advice contained in this presentation is suitable for you. Right? It's not tailored to your personal circumstances. It's just general advice only. Okay. Now, tonight's webinar is focused on picking direction, right? That's what the email that you've signed up for is, that's what will be a strong focus of tonight's webinar. But I also like to cover some of the other key areas that I think you need to be good at in order to be a successful trader. There's a lot of information out there, right? I mean, you can, my God, I mean, everyone's an influencer now. They're called finfluencers. Things like TikTok have a bunch of videos, and I encourage you to go and explore all those things. I know I do, mainly for entertainment rather than education. But if you wanted to boil things down on things that you need to focus, I think these are the three main areas that you can see in front of you. So picking direction, obviously. It's good to have a few strategies under your belt. A strategy, things like, I know buy low and sell high is a bit of a no-duh, but it is technically a strategy, right? It's an obvious one. That's like saying breathing is a strategy, I know. But there's other types of strategies that you can implement that I will briefly go into tonight. Risk management, obviously, is important because you're not going to get every trade right? Now, what brings all those together is a set of trading rules. And this is something that I always say. If you switch off after this because you find me boring, or because, oh my God, I've heard this before, or whatever reason, I won't blame you. It's okay. It's 7 o'clock at night. I know I'm fighting other impulses. But if you do take anything away from tonight, it's basically this. And it's that every successful trader I know has some sort of trading rules. And if they're successful, it's almost certainly because they're consistent. Trading rules don't have to be super vigorous, but you need to have a set, right? So if you're new and again you're looking for something looking to focus your education, then picking direction, strategy, risk management, and then bring it all together as a set of trading rules. All right. As I said, there's a lot of information out there, right? You can see, I've thrown a few ridiculous images in there. You got the Wolf of Wall Street, the AFR. You got Wall Street Bets, which is, infamous now. You have American politics, COVID. You have other indicators and other things going on, right? The idea is to be able to boil all that down into a set of trading rules and digest it through a set of trading rules. It's like a meat grinder, yeah? Got all these bits and pieces from who God knows where. The sausage on the other end is the trade, right? And your meat grinder is your set of trading rules. I've never used that analogy before, so forgive me. It's not particularly attractive, is it? So as I mentioned earlier, there's a few key benefits of trading rules. I mean, the first off, they keep you disciplined, and they really just kind of take the guesswork out. There's something to be said for hunches. There's something to be said for feelings. I'm not someone who completely disregards those. I know that it would be, I guess, intuitive to say that you should disregard feelings and emotions. And that's true for a beginner, but I think that they're still applicable in some ways. They just shouldn't lead your analysis, right? Experience counts for a lot, and experience gives you those kind of feelings. As a beginner, your feelings can't be trusted because you don't have experience. So your feelings are probably based off something that hasn't been proven, and they're probably based off something that's more to do with fear or your attachment to money, psychological issues that come with trading at any point, whether you're a beginner or you're experienced, right? So in the beginning, set of trading rules helps remove that emotion. It helps remove that gut feeling. It can really reduce the stress of trading because it's mechanical, right? And ideally, you can trust them because they're logical and they're tested. You obviously don't want to just follow a set of trading rules where if the wind blows east, you buy stock, right? Obviously, they need to be logical and they need to be tested. And you need to be able to have the ability to change them. Where we can help with this is, one, we give our clients a set of trading rules. If you come along and do our course, we'll actually give you a set of trading rules that you can practice and learn from and then build upon if you're as you get experience. That's one thing that we can provide. But the other thing that we can provide is we can actually help you alter your trading rules that suit you, right? And it's good to have a kind of mentor that can do that. So it's really good to either go get some education from an education provider like us, or go find a mentor like us as well. I know it sounds very self-promoting, but obviously we've been doing this for long enough. We're a small business, and we believe we have the best education and best support in Australia. And I'm sure our clients believe that as well. I mean, there's no short of testimonies out there to say that. But my point is that if you are going to learn to trade, doing it yourself is fine. You can go and learn what you want to trade, and you could do it for free. That's fair enough. But before you go and start trading with real money, go and get a proper education that gives you structure, or have a mentor that can guide you. Don't have one of those things, preferably both, but don't have none of those things. There's a fair amount of our clients who tried the path of self-education, lost a bunch of money, and then have come to us. Does that mean we turn them into profitable traders? No, not necessarily. Not all our traders make money. That's obvious. That's fair enough. But we're going to give you the best chance of success, I think, right? It's just my opinion, but I think I think we're going to give you a much better chance of success than you are you helping yourself, because you're not experienced, so how are you going to know, kind of thing. But anyway, I digress. I told you, my type of webcast, I can waffle on a bit, so forgive me. By the way, if you've got any questions or comments, type them into the chat box. I can see them. I'll answer them as I go if I catch them. If not, sometimes I'll leave them to the end and I'll answer them then. I'd actually like to hear what your guys' opinions are, or if you've got anything to say. If you want me to look at anything, you can always type that in as well. For next Thursday, again, for any of you latecomers, you've all been signed up to next Thursday's webcast at 1 o'clock. That's going to be basically applying a lot of what we teach tonight, right? And I'll cover this again at the end. So if you've got any stocks that you want us to cover in that webcast next Thursday, just type them in and we'll actually have a look at them. And we can look at them a little bit fundamentally, even though that's not really the focus of this webcast series. But we'll look at whatever you want us to look at. So just type them in, preferably Australian stocks, preferably. Albeit you can do American as well. Now, there's two types of analysis if you don't know, broadly. Okay, I would say that these are catch-alls. You have fundamental and you have technical. Now, each of those types of analysis can be boiled down into their own kind of analysis, right? So these are umbrella terms. Technical analysis, which is the focus of tonight, is more about looking. In essence, it's about looking at past price data to predict future price movement. That's basically it. Past price data, you could get an Excel spreadsheet of every single price that stock is traded at for the past year if you wanted to. And that might be useful for Rain Man or something like this. But for us, normal people, we prefer to have that displayed as a chart. So technical analysis, forgive me, technical analysis is essentially looking at charts, right? It also includes cyclicals. So, I mean, that's charts as well, but it's about like a Christmas rally is a form of, I would call technical analysis. People call it cyclical analysis, but it falls under the banner of technical analysis. We're going to go much heavier into this. Fundamentals, on the other hand, are basically everything else, right? So fundamental analysis is about looking at company reports. It's about looking at the inherent value of these businesses. It's about looking at their profit and loss and their revenue, their directors, you know, has it got a good management team? Did they beat their expectations for their report? Are they paying a dividend? Do they suffer under higher interest rates? I mean, these are all fundamental points that you would look at for a company. Now, you might ask, well, which one should I do? There's not a very clear answer to that. Of course, there's not a clear answer to anything. But I would say this. Technical analysis is superior for short-term trading. Fundamental analysis is superior for medium to longer-term trading. Does that mean you should just focus on one? Not necessarily. Well, you should focus on one, but that doesn't mean you exclude the other. That's probably the way you should say it. So, for example, you know, I might look at a stock fundamentally and think, oh, well, it's a nice stock. You know, it's fairly cheap at these levels. I think going forward in the future interest rate environment, that a value stock like this is going to do much better than where it is now. And so I think it's going to go up, right? Fairly simple. Now, obviously, it's more rigorous than that. But let's say I had a particular fundamental bullish view of a stock. I would then wait for technical analysis to line up before entering the trade so that I could time my entry better. And considering I am more of a short-term trader, I am going to listen to my technicals a lot more as well. Okay. Now, does that mean you need to know about fundamental analysis in order to be a successful short-term trader? No, you don't. No, you don't. Equally, do you need to know about technical analysis in order to be a good investor? No, you don't. Okay. To be honest with you, whatever works for you, just keep doing that. And if it's not working for you, then obviously you need to change something. Fair enough? All right. Now, the foundations of technical analysis I kind of briefly touched on, but we could essentially break it down into basic principles. Yeah. So one analogy that I like to use is that technical analysis is, in essence, like painting a picture, right? I think it's a pretty good analogy or metaphor. Yeah, metaphor, right? Where if you want to paint a picture, what you're essentially doing is you're trying to put an image in your mind onto the canvas, right? And in order to portray that image to someone else, you need to have things like a line, you need to have things like color, you need to have maybe, I don't know, space or negative space or something. Maybe you need to have some shading, you need to have shape, texture, rhythm. Going back to my art days in high school, right? It's not really until you've applied these basic elements or principles does the image become clear to someone else. Does that make sense? Technical analysis is kind of the same thing, right? You get a chart up and you apply your trends and your counter trends. You apply your support and resistance. You identify technical patterns. You look for entry and exit signals to time it a bit better. And then you confirm with your indicators. And it's not until you've applied all these kind of things does the image become clearer. And hopefully that image is where the stock is going in the future. Does that make sense to everyone? So this is what a chart of the XJ. I actually haven't updated this. This is a month old, right? But I can bring up I can bring up a chart now. Here, I'll show you. All right, so this is not the XJ, that's BHP. So I'm just quickly. All right, so this is the XJ, and you can see I've got lines everywhere, right? I've got it's messy, and you know, if you've got some experience, then you probably understand what all these lines are, right? This is actually fairly tamed. You can go much more hectic. People have it can get wild, right? But what all these lines are helping me do is build the picture of where I think the stock is going, or in this case, the index. Now, the XJO, just quickly in case you didn't know, is the correct term for the ASX 200, right? I shouldn't say correct. That makes me sound a bit elitist. But I've always known it as the XJO. The ASX 200, I think, is another term for it, in fairness. It's like the S&P 500, right? So the XJO is the top 200 stocks of our market, weighted by market capitalization. So if someone says to you, oh, the market, it was up a lot today, or geez, did you see the market was down today? The market is this, it's this chart, essentially, right? If someone says the US market, it's the S&P 500, okay? It's not the Dow and it's not the NASDAQ, because the Dow isn't a random 30 companies. There's no logic as to what's in the Dow. People don't know that. They think it's the top 30 companies. It's not. There's a lot of the top 30, but it's just not. It's random. I don't even know. And then you have the NASDAQ, which is a weird name, that represents mainly tech stocks in the US, all right? So when you actually talk about the US market, you're talking about the S&P 500 because it's a bit of a catch-all. If you wanted to get specific, you could say Dow, or you could say NASDAQ if you're talking about tech. All right, just a bit of a quick education there. So our version of the S&P 500 is the XJO, or the ASX 200. And so this is our market, right? As you can see, it's a pretty messy screen, right? What I want to do, hopefully, by the end of this presentation is give you a basic understanding as to what all these lines kind of mean, okay? Now, again, I have a tendency to speak fast, and I think over the years I've learned to slow down a little bit. If I am going too quickly, then, or if you want me to repeat something, then by all means, put it in. This is a webcast, I would say, aimed a little bit more for beginners, okay? All right, so when you're looking at a fresh chart, right, and that's what this essentially is. This is what you call a bar chart. Other types of charts are line charts and candlestick charts, right? I would say these are the three most popular. Line charts are useless for technical analysis, in my opinion. If you want to fight me on that, fair enough. Line charts are very basic because they only show you the close. And so they're only showing you, in my opinion, a fraction of the data that you could be looking at. But that, in fairness, more data doesn't necessarily mean more success. And people need to recognize that. The other popular type of chart is a candlestick chart, right? And it's essentially the chart that you're looking at, except the range between open and close are filled in. That's the only difference, right? So when someone says, oh, I don't look at bars, I don't look at candlesticks, that's fine because you're essentially looking at the same thing. So if tonight if you yourself prefer a candlestick chart, that's okay. Everything that we're going to run through tonight, you can apply to the same charts, no problem. Right? It's the same information, just displayed visually, aesthetically, slightly different. It's like saying I like the color red as opposed to the color green. It's much of a muchness. It's horses for courses is another way of saying that, right? So the first thing you want to do on a blank chart when analyzing a new stock is essentially draw in what the market range is. The trend and the market range. In this particular circumstance, you can see that it's certainly trading in an uptrend. And what we want to do is we want to draw in an uptrend line that's underneath the stock, which is essentially a support level. Okay? It's a support level with a gradient or a slope, another way of saying that. And the reason why we draw it underneath the price data or the bars is because every time the stock has returned to this line, it's bounced again, right? Even here is a roundabout thing, right? Through here, it held it, and then through here, it bounced again. So in some ways, what you're doing is you're creating a rule, aren't you? You're saying, okay, well, every time the stock has returned to this line, it's bounced again. And I can project that line into the future, can't I? Right? Because it's linear, it's a straight line. And so if I ever see the stock returning to this line again, that gives me an image, like a rough idea of what the stock could do, right? Because every single time it's come back to this line, it's bounced again. It's a 100% effective rule. Does that mean it's going to work again in the future? Guaranteed? No, right? Because otherwise I wouldn't be doing this webcast and I'd be on an island in Tahiti somewhere, right? Escaping all this COVID business, right? So obviously it doesn't work 100% all the time, but it gives you, it's just one piece of the puzzle, really, at the end of the day. It's just one piece, one principle applied to the canvas. The next thing that you want to do is define the market range. Now, I've chosen a pretty chart, right? This is obviously, I want to find a good example for when I'm teaching, right? Not all charts are going to look this pretty. Not all charts will have this perfect ascending channel that you're looking at here. Sometimes the market range can be, might not be there or easy to identify. So the thing about technical analysis is that if you're, after say a month of doing this or something like that, provided you've done some good education. So after a while, if you're starting to look at the screen like this and you kind of have to get in and, if it's really hard, the point is you probably just move on, because there's like 200 stocks that you can trade. 80 of them you can trade options on. Just move on. If it's too difficult, just move on. And if there's no trades that day, then so be it, right? So sometimes it is good just to hunt for these pretty looking stock, right? Don't. No one's forcing you. No one's got a gun to your head, right? Where you have to trade. Now, we don't typically draw uptrend lines on top of the stock, but because it's exactly a parallel line, I mean, even if it wasn't, that's a type of chart pattern, but I don't want to get into that. The idea is you're just trying to define a boundary, right? You're trying to go, okay, well, fair enough. Every time the stock bounces off the support level or the uptrend line, it seems to hit this other line, this resistance, and it almost certainly turns around every other time, right? And so that starts to also help add another piece of the puzzle, start making the picture a little bit clearer on the canvas. You know what I mean? Once you've drawn in your trends and you've defined your market range, the next step is to draw in what I call more traditional support and resistance. And the reason why I call them traditional is because when someone says support and resistance to me, I always think of horizontal lines, right? Lines that are horizontal rather than have a slope or a gradient. And what you want to do is you want to look for a key level of support and resistance, preferably that has had multiple touch points. So preferably that have every time so you can see, I'll give you an example. You can see the stock has reached this resistance level here and turned around, and then it touched it again and turned around. So that's 2 touch points, right? If you wanted to, you could split a few hairs and you could say, well, it turned there and 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 it turned. You could argue that to me if you wanted to. I mean, it's inconsequential. But the way that I would suggest that you measure it is when there's a proper turnaround. So there's like a peak or an apex, right? So it goes up and comes down, up and comes down. Okay. Now, does that mean you can't consider other lines that only have one touch point? No, right? What it's about is degrees of confidence. It's degrees of validity, if you will, right? So something that has been bounced off several times, it has far more confidence behind it. It's far more valid than something that's only been touched once, right? Now, does that mean you should completely ignore the one touch? Probably not. But it shouldn't have a lot of bearing on your decision making. There's no objective way of doing this. You can probably tell, right? It's a creative process as well as perhaps a scientific one, all right? Now, the next step, by the way, I haven't drawn in a support level, but I would encourage you to do that as well, okay? I just didn't want the chart to clutter up too much. Fair enough? All right. Now, once you've drawn on your trends, counter trends, your support, your resistance, your market range, once all your lines are on the chart, what you can do is you can take a step back a little bit and you can see if you can see any chart patterns. And chart patterns become a lot more obvious once you've drawn those lines on, right? So for example, one type of chart pattern that I mentioned earlier was the ascending channel. But the other one that we can see right here is highlighted in orange. You've got the uptrend line converging with the resistance level, right? I mean, this is technical analysis 101, right? These are what you call triangle patterns. You can, I mean, Investopedia, there's a lot of free resources on this. This is not groundbreaking stuff, right? But I'm giving you a process here, aren't I? And that's, I think, the gem in this presentation, if you already know this. So I digress. The uptrend line and the resistance line are eventually going to meet at the point of a triangle. Agreed? They're not perpendicular. Wait, no, they're not parallel. Sorry, they may be perpendicular. They are eventually going to meet. And when they do meet, the stock will have to break one of them. It'll have to break the resistance, or it will have to break the support, which is the uptrend line. Now, on this particular chart, you can see that it's broken the resistance level. Now, that's a fairly common occurrence. Uptrend lines generally win, right? I know that sounds obvious, right? But it's something to keep in mind. So when you're trading a triangle pattern, rather than, if you're thinking about trading the bearish move down here, it's probably not a great idea, because generally speaking, the triangle will break in the direction of the stock. Karen, we can look at an actual chart if you want to. 7:30. If we'll go over time, but that doesn't bother me. I mean, I'm double parked. I have Mountain Goat Steam Ale, and I've also got a Plantation Rum. I think it's a wonderful pairing. I'm wearing a Hawaiian shirt. I think it goes together. So you know, I've got my drinks, and you know, if I get hot, I've got my fan. So I'm happy to go over time. We can go look at some charts if you want. If there's any stocks that you want me to look at in particular, Karen, just type them in. I'll have a quick look. Right now, I'm not going to spend a great deal of time on them, because that's what next Thursday's webcast is for. But you know, we'll have a look, and we can apply all this. So more often than not, triangles break in the direction of the underlying trend. And in this particular circumstance, you can see that's what it's done. And that kind of brings me to the next step. The next step is to identify the break of the pattern, right? If it does happen. And that can help identify an entry signal. So you can say that the stock is trading in this particular way or that particular way, but when do you get in? Like, do you get in yesterday, today? Do you get in tomorrow? I mean, let's be honest. When it comes to short-term trading, the majority of issues really rely around timing. Like, there's a lot of trades that have gone against me that I was like eventually right. I mean, and when I say eventually, I don't mean over the next year. I mean like a week later, right? So timing really helps. If you can get your timing right, and that's, I would say, half the battle, then you know you're looking all right. So the next step is to identify entry signals. I'm not going to go too hard into this because there's a bunch of them. The next step would be to look at your indicators, right? And this is your final step. And there's a reason why I put this at the end of your analysis, right? This is like the last bits of detail on your canvas, right, to help bring it to life. The reason why you put it at the end is because they're confirmation tools only. A rookie mistake I've found over the years whilst teaching and supporting people is that because they're kind of really cool and they're really easy, people begin their analysis with them, and it creates a biasness when they do the rest of their analysis. Does that make sense? So, for example, the stochastic here are, this is called the stochastic oscillator, right? There's an overbought range, which is represented by the horizontal dotted line. And there's an oversold range, which is represented by, again, the horizontal dotted line down the bottom here. You can see when, like, if you match it to the chart, every time the stock gets to an overbought period, right, it turns around, right? Gets overbought, turns around, gets overbought, turns around, right? So it kind of follows the stock. And it's what you call a lagging indicator, right? Now, you use the stochastics for a few different things. One is to gauge momentum, right? So if they're opening up like they are now, that indicates hopefully some momentum, right? And so that can help you time your entry a bit better. You obviously want to get in on a bit of momentum. Two, they kind of help confirm direction. So if both of the stochastics are pointing up, then, as long as they're not pointing down, then doing a bullish trade is probably okay, right? And finally, they're used for what you call divergence. And I'm not going to get into that because I think that's advanced, right? We don't teach our clients divergence in the beginning. It's something that we'll probably touch on later. But you could go look it up. I mean, there's wonderful videos on it. So these are confirmation tools, and because they're kind of like a bit of a cheat. People in the beginning, I don't want to use the word lazy. It's probably not the right word because it has a negative connotation, but people will basically begin their analysis with it by going, oh, stochastics are pointing up, they're spreading wide. It's probably going to be a bullish trade, right? And then because they've got that in their mind, when they do the rest of their analysis, it's less objective, I find. They're looking at it through a particular lens. Okay, so confirmation tools only. Now, there's plenty of other stochastics out there, right? Stochastics. There's plenty of other indicators out there. Popular ones are the RSI, also known as the Relative Strength Index. There's the MACD, which is similar to the stochastics. There's the moving averages, which are on the screen, which I'll run through in a moment. What else is there? Bollinger Bands, which I use. Anyway, a bunch of other stuff, right? Those are the very popular ones that people use on a day-to-day basis. I really like the moving averages. Some people do, some people don't. Again, we wouldn't necessarily teach it to beginners. I think they're fairly simple. Probably a little bit better for medium to longer term styles of trading, but also good for short, I think sometimes. I'll give you a quick example. You know how I was talking about support levels, right? For example, the uptrend line, every time the stock gets to the uptrend line, it bounces, right? Well, I should probably stipulate, the green is the 50-day moving average, the blue is the 100, and the red's the 200-day. These are just simple moving averages. They're not exponential, by the way, if you know the difference. You can see, like the uptrend line, every time the stock returns to the 50-day moving averages, it bounces, which is pretty cool, right? Because it means if it returns to the 50-day in the future and shows an entry signal, then perhaps it's a good time to get into a trade, right? Provided, all your another analysis is done too, and that fits your rules and all that type of stuff. So you can see tonight, nothing I've shown you tonight is rocket science. I mean, this is not complicated. It's certainly something that anyone can pick up, I believe, right? We've got old, young, smart, perhaps less smart clients, people who are full-time professionals, small business owners, people who are very busy, people who, all walks of life is really what I'm trying to say. And all of them can learn this, right? I've never had a student who doesn't understand this stuff, okay? Some take longer than others, but as you can see, it's fairly simple. I think the secret here and what we provide our clients, aside from the support, is a bit of a recipe, an order of process, a set of trading rules that teaches you how to apply these things appropriately, so that you can actually arrive at a decision, okay? So to summarize, you always want to start with your trends and your range. Now, you can start with a 6-month chart. I probably wouldn't start with anything less than that and then zoom in. You want to look at key resistance, key support levels, okay? Look for things with plenty of touch points. Remember that a resistance and a support can swap roles. It just depends on where the share price is. Patterns or patterns, if you're playing the home game, and breakouts, entry signals, confirm with your indicators, and consider your fundamentals, right? You don't have to, but it's something that you should, if you know about fundamentals, certainly consider them, okay? The next step is to plan the trade. And that's when you start getting into strategy, which is the next piece of the pie, if you will. So, as I mentioned to you, one strategy that everyone knows is buy low and sell high. I know that's not particularly fair, right? Perhaps a better example of a strategy is something called averaging down. Some of you who trade stock, that's a type of strategy, right? It's a good one, but it shouldn't be the only strategy in your portfolio, right? Or sorry, in your toolbox, if you wanted to call it that. So strategy are like tools. It's another metaphor that I like to use. having a range of different strategies allows you to trade a range of different market conditions. And if your goal is to generate an income stream, it would make sense to be able to trade different market conditions, because there's a couple of things here that I want you guys to really understand. One, the market doesn't always go up. So if it's not going up and your only strategy is buy low, sell high, average down, that type of stuff, one, you're probably going to start losing money because you can only trade that. And two, that's the only way you know how to analyze a market. See, if you know how to trade bearish markets, if you can make money from bearish markets, if you can make money from sideways markets, then what you're going to do is you're going to analyze the market with less bias, right? Because you don't care, right? I prefer the market to go up. Everyone does. But if the market's downtrending, or, if a stock's going down, that's fine. I don't care. I'll just do a bearish trade and hopefully make money that way, right? And that's what having different strategies allows you to do. Again, going back to the metaphor, if the only tool you have in your toolbox is a hammer, then everything starts looking like a nail. That's how you deal with every situation, is to hammer it in. And sometimes that's not appropriate. Sometimes you need a screwdriver or a saw or whatever it is, right? Now, the way that we trade different market conditions is we utilize different instruments. They're all exchange traded, which means they're all traded on the ASX. So they're like buying and selling stock. What that means is that they're transparent and they're regulated, which is very good. Something that we prefer. Protects you and it protects us. But what these different instruments allow you to do is just have more flexibility. So you can trade bearish markets, you can trade sideways markets. You can have choices of leverage as well, which means you can use less capital in order to make more money relative to buying and selling stock. Obviously, the flip side of that is that you can also lose more money. And these types of derivatives, what they're called, need to be, you need to know what you're doing, right? Because risk is not a problem if you can manage. Well, risk is a problem if you can't afford it, one, but it's not a problem if you kind of know what you're doing and you can afford it, right? So don't take risks that you can't afford to take, right? But once we move past that, don't take risks that you don't understand is also the next step, okay? And that's what we kind of teach. We teach these derivatives if you want to learn about them. Karen's asked, what do I think about short selling? Philosophically, I don't agree with it. I'm politically aligned. I'm not a very capitalistic person, believe it or not, even though I kind of work in this environment. I don't think short selling is honorable. I know that doesn't matter. It's probably not even what you're asking. The real answer to your question is, do I think it's an appropriate strategy for retailers like you and I? No. I think there's way better things that you can do in order to profit from bearish movement. I'll show you some tonight. But short selling stock comes with a whole bunch of problems, and I don't think it's appropriate for retail traders. If you're a big institution with lots of money and lots of power, then short selling is fine. And that's part of the reason why I don't agree with it philosophically. But as a retailer for you and I think there's just way better ways of doing it, and so I would never short sell. I would just buy a mini short, or I would buy a put option, or I would do a bear call, or I would do a calendar bear put. There's I can think of 5 strategies off the bat where I make money if the stock falls without having to short sell. And I'll give you a rough idea of that tonight. There's no quick answer with me, Karen, right? So everything's going to come with, a long answer. Obviously, the trading rules line there is basically to say, obviously when you do these strategies, use a set of trading rules to help you implement them, especially because they're higher risk, right? Leverage, short-term trading is higher risk. If you want to make more money in the short term, guess what? You have to be able to lose more money in the short term. There's no free lunches in this market. Risk is a function of return, right? So trading rules helps reduce that risk because you have a mechanical process that's hopefully being tested, okay? Now, as I mentioned, derivatives, and I haven't forgotten, Karen, I will go have a look at actual stock. Derivatives just provide flexibility. As I said, it allows you to trade different market conditions and allows you to have leverage. The two types of derivatives that we trade, all of them are exchange traded, mini warrants and options. And if you haven't heard of those before, you can go Google them. There's a bit of a renaissance going on with options in the US particularly. That's not a good representation of what we do, okay? But that is the same instrument that we're trading, okay? So warrants are fantastic. If you haven't heard of warrants, I think it's a complete failing on the market and a complete failing of the ASX that all of you don't know about mini warrants, because mini warrants are the bee's knees. I can be hyperbolic at times, but I genuinely mean warrants are rad. Let's go back to the 80s. They're cool, yeah? They're, what they do is they allow you to trade about 200 different stock, currencies, commodities, and overseas indices. Not all currencies, not all overseas markets, obviously, but some. And you can do it all through the Australian market, which means you don't have to open a Forex account. You don't have to open up a foreign trading account, right? You don't have to open up a futures account, any of that type of stuff. Yeah, you can just all do it. Like, for example, if you have a ComSec account, you can go trade mini warrants tomorrow. You might have to call them up and ask to be allowed to do it, and they might have to just turn on a button. But you can do it through any trading account you have in Australia, I'm pretty sure, okay? That's one benefit. The other benefit is that they allow you to trade bullish trades as well as bearish trades. And so this is what I was talking about, Karen, where you don't need to short stock when you can trade warrants. There's a very, very small funding cost. So, I can't remember what the percentage is, but it's so negligible that I can't even remember what it is. Like, if I put a $2,000 trade on and I hold it for 6 months, I might lose like $10 or something. It's so negligible, I don't even know what it is. Do you know what I mean? So if you get up into hundreds of thousands of dollars or tens of thousands of dollars, maybe it can be a little bit, but I mean, you know, come talk to me and I'll tell you kind of what to do there. But regardless, you can trade bullish and bearish strategies, and they're capped risk. So if you put $2,000 on a trade, the most you can lose is $2,000. But here's the kicker, right? They have inbuilt stops. So if you put $2,000 risk on the trade and it goes through the stop, you might only lose like $500 or 25%. Now that sounds like a lot of money, but you can also make 25% with the same amount of bullish movement or bearish movement in your favor, right? So the reason why another reason why I like these things is because of the leverage. So let's say you had a bullish view or a bearish view on Origin, let's say. Instead of putting a 10 grand trade on to make $100, you could put a $1,500 trade on to make $100. It's just that it's got to come in the same amount of speed. Does that make sense? And that's what's awesome about leverage. You can see that if you don't know what you're doing, then with the same amount of bullish movement, you're also going to lose $100. And $100 on 1,000 is 10%, whereas $100 on 10,000 is only 1%. And that's where it kind of freaks people out a little bit. So I rarely buy stock. I like JBH, for example. I think that's a good stock. Rather than buying JBH, I'll just buy a mini long, let's say. You know what I mean? Because it means I don't have to put 10 grand to make some kind of reasonable money. I can just put a couple of grand on. You know what I mean? All right. And how much you risk is entirely up to you. I'm not telling you to trade with 10, 2, or 1, whatever. That's up to you. But my point is leverage just allows you to use less capital to make the same amount of money when it comes to buying stock. You know what I mean? Right. You can tell I'm pretty passionate about that in particular. Now, the other type of strategy that we do is options, and we don't teach this to beginners because they're very complicated. Options are by far the most flexible instrument that you can trade on the Australian market. By far. And what I mean by flexible is that you've got an insane amount of choice of leverage, and you've got a lot of different strategies that profit from various scenarios. So you can basically trade any market condition with options. there's strategies where you make money if the stock goes up or sideways. There's strategies where you can make money if the stock goes down and sideways. There's strategies where you can make money if the stock goes up a lot or down a lot, which is pretty cool. So for example, when it comes to company reporting, which is about a month away, next month, we're going to be doing heaps of these strategies, right? Because, and a lot of our clients are as well. You need a higher amount of capital, I would say, typically. But, and when I mean higher, I mean like, if you're used to doing 3 or 4 grand trades, you might want to pump that to 8. Basically, on the back of a report, you have to agree that there's a good chance the stock moves a lot, right? Like, I could show you a chart. Like, here's just an example. Some of these big movements, not that day there, but some of these big movements are on the back of reports. Yeah, some of these big movements are on the back of reports. I don't know which one it is on this chart, and I probably should have prepared that. But my point is that reports can move the stock up a lot or down a lot, but you don't know which way. Like, even if you had inside knowledge, let's say you had a guy work there and he called you up a couple of days before and he said, hey, don't tell anyone, but the report's really good. You should buy some calls. Even if they told you that, which is highly illegal, by the way, and I'm not saying, and you should never trade that. Even if you knew that, you don't know how the market's going to react. See, I've seen some reports be really good and the stock plummet on it. Why? Well, there's various reasons why that could be, and I'm not going to go into that. But my point is that even if you know the report's going to be good, you have no idea how the market's going to react. And so by implementing this particular option strategy, you don't care. You don't care if it goes up a lot or down a lot. What hurts if it doesn't do anything, and that can happen, right? And so obviously there's an ability to lose money there with any trade, but it kind of takes the guesswork out of where that report's going to go. So it's just an example of how options are also really cool. But you can't just do this stuff without being educated first. And the education on options trading out there is, in my opinion, really subpar. Anything that's free out there, well, I shouldn't say anything. I've checked out a lot of free content on options trading, and it's really not that great. And can I just say, the ASX education on options trading is also not very good. All right, we, you know how I know this? Because we actually provided some of that education many years ago, and they haven't updated it. Anyway, that's just me being a little bit catty. But yeah, the free education out there on options trading is not particularly great, but you can learn it. We obviously teach options, but we prefer not to teach it to beginners. What we prefer to teach you first is mini warrants and picking direction and risk management. We think that's much easier launch pad. Options is just a little bit too complicated because of its flexibility, right? With flexibility comes complexity, but it's something that you can learn later on. Now, the final step is obviously risk management. Now, risk management is, is the final piece of the puzzle because you can't get every trade right. And one common mistake is that people are really disciplined at taking profits. I find it's funny. They'll take 20% profits consistently, but then they'll have one trade every now and then that they'll lose everything on, and that can wipe out their other profits. And that's a problem, right? And by the way, if you've been trading for, I don't know, a while, if you've been trading for over a year or 2 years on an active basis, you've had a loss that's 100%. I've had a loss that's 100%. I probably will have another loss at some point in my life that's 100%, because you're never perfect, right? But just because you're not perfect doesn't mean you don't try your best. And risk management kind of helps keep you accountable, hopefully helps keep you a bit honest and on track, right? So that's the other kind of piece of the puzzle there, okay? Now, I was going to go into, look, I'll just quickly cover this because I think this is important. I always cover this. You need to consolidate why you're trading. I want to make money is fair enough, but it's also, you're probably thinking a bit too shallow. Maybe go a little bit deeper. What does more money mean for you? I actually just really like the market. I find it interesting. Even if I don't have money, if I was really poor or whatever it was, I would still look at the market because I find it interesting. But if you want to generate an income stream, let's say, what does that mean for you? Do you want to be a full-time trader? Perhaps you just want to be a part-time trader, right? I just want to be a part-time trader. I don't want the stress of full-time trading. Maybe when I get to a much older age and I want to slow down, and my brain hasn't been uploaded to some kind of digital consciousness yet, maybe I'll go to more full-time trading. But part-time trading is a really good goal to have, I think, where it's good to have just a bit of a secondary income stream. You can use it for discretionary spending. You could help pay off the house, maybe. You could use for holidays. You could just try and build a bit of a nest egg, whatever it is, right? But it's not paying the bills. Full-time trading pays the bills or partly pays the bills. And that I only recommend once you've got years of experience. Okay, so I'm not going to sell you some dream where it's like, picture yourself on a beach and you're alone and you hear the children's laughter. You look down at the screen and you see that you've made another $1 million. I'm not going to sell you any silly dreams. The point is that full-time trading is something that's really only achievable after years of experience. And once you're used to the stress of trading, because you're paying the bills. And that's all well and good if it's you. But let's be honest, if you're at an age where you've got that kind of capital, chances are you've got a dependent or you've got a partner who might not be particularly happy with, eating baked beans one night. You know what I mean? So, yeah, anyway. The other thing that I've noticed over the past 10 years, I forgot to introduce myself. Oh, my Lord. I've been doing this for about 10 years, right? And one thing that I've noticed is that there's types of qualities that our most successful traders share. The first and most important one is consistency. Consistency is super important. You don't want to be consistently wrong, obviously, but you need to look at what I mean by consistency is you need to look at the market in the beginning virtually every day. You need to put in a little bit of time every day. And what I mean by that is that you don't have to sit in front of the computer for hours, but even just spending 20 minutes about reading about what's going on, looking at some charts, applying what you've learned is going to be a lot more helpful than you doing an hour on the weekend. All right, do it at night. Yeah. You might be like, well, I'm really busy because I work full time. I have 3 kids and they're all nightmares. And, after I've cooked dinner, put them to bed and blah, 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 right? I mean, the stresses that kind of carries is fair enough. But don't forget, by putting a consistent effort in as a beginner, you actually get more efficient, which means you can actually implement it during your workday. So what might take you half an hour will eventually maybe only take you 5 minutes, and that's easy to fit into a lunch break. So just keep that in mind. Sometimes you just got to do the hard work in the beginning. Discipline is also really important. That's discipline to take a profit. That's discipline to take a loss. It's discipline to stick to your trading rules. It's discipline to be consistent. Discipline, right? Fairly obvious. Independence is important. I think this is interesting. The best trader for you is you. It's not me. So I can give you trade ideas, but you need to pull the trigger on them in a sense that you need to understand them. You need to tell me yay or nay. You have to tweak them a little bit. It has to fit your risk profile. Investing is a little bit different. I can invest for you. I wouldn't, but I mean, we have managed portfolios if you look into that kind of thing, because it's longer term. But shorter term, the best trader for you is you. Okay, so independence is important. You need to be driven to succeed, obviously, and you need to enjoy it, right? This can't be a chore. If this is just a means to an end, you're probably not going to make money. I know that's, again, I would say fairly obvious, but I don't know if you can remember being back at school or studying or anything like that. Subjects that you're interested in are the ones that you do better at, right? Unless you're studying STEM, in which case, let's be honest, that's just a grind. All right. Now, before I get into this, I'll go have a look at those stocks, right? I think this is the stuff that I want to finish on. So let's go have a look at some stocks. All righty then. So now I'm going to get Tim to look at these again next week, Karen. Okay, because in fairness, tonight's webcast is not particularly about going through the market, looking at stocks. Okay. BRN is this is the right one, isn't it? Yeah, this is Brain Chip. Okay, cool. I don't like the stock. Plain and simple. I think it's a bit of I don't like hype stocks because I find them hard to decipher. If you trade hype stocks, that's fine. That's almost like a third type of analysis, right? Technical analysis, fundamental analysis, and then social media analysis. Maybe we'll call it that. Social media analysis is fine because you can make plenty of money off it, and people do. So I'm not trying to knock it. It's just not where my skill set lies. I look at the fundamentals of a company, perhaps look at the technicals. Hype can make you money because it pushes markets. Sometimes you get rug pulled. More often than not, you do, right? There's always someone left holding the bag at the top of the chart. There's something called small cap charts. Can I small cap? This out. Ooh, template, maybe. I've looked this up before. I should save it because it's come up more than one. Small cap? No. Oh, yeah. Oh, where is it? There's this kind of broad template for a for basically a rug pull, right? And it gives you a rough idea on how things generally go. And I can't find it right now. I'm not going to waste any more of your time. But essentially what it does, the market goes up a lot and then it dumps, it gets rug pulled. And then there's a little bit of push up. And then there's another, it's like a bull trap, and then it comes off again. And then it finds kind of a mean. And it usually returns back to the underlying trend. So if we were going to apply a little bit of what we learned tonight, first thing that we do is we draw our trends. Now, ignore these straddling orange lines. I haven't run through those tonight. So these are, this uptrend line is a very simple uptrend line. It's, it's got plenty of touch points, 1, 2, 3, 4. Once this stock gets rug pulled, which I have a feeling it will, it might not. I could be completely wrong. I don't care. If it does, which I suspect it will, and it might not be tomorrow, might not be this week or this month, it will likely return to this trend, which is kind of cool, right? Because it gives you a bit of a target. So once it does return to this trend, thereabouts, right? And if it's in the future, it might be here, it might be there, who knows? Once it does, though, it can give you a bit of an opportunity to buy back in. Now, by the way, if is it Gra? I'll just call you Luther, if that's okay. Luther's been, if you don't mind me saying this, Luther's been holding BRN for 4 years, has been a solid investment so far. And that's awesome, right? And I'm not trying to knock the stock, but it's certainly a social media kind of stock, isn't it? Like it's like GameStop, or what's the rocket one? Anyway, there's a whole bunch of them. I read them a little bit, but it's not where my focus lies because the vast majority of my time is being taken up, rightly so, by clients needing help for their trades. It might be a good investment. As far as the fundamentals look, I'm not particularly happy with them, and that's okay, right? Fundamental analysis isn't my strong suit. It's actually my colleague Sam Green's strong suit. So if you're ever interested in talking about the fundamentals, have a chat to Sam. What I would typically do before opening my mouth and making myself seem silly is I'll go to emeraldequities.com.au, right? Sorry, hang on. My spelling is terrible. I'm a good writer, but I'm a terrible speller. I would log into the sister company here. I would go to my stock screener. I would go and look at the fundamentals of the company before, making a decision about its fundamentals, right? And then what I would do is I would apply my technical analysis. Off the bat, though, Sammy, my colleague who sits next to me, he's much better with fundamentals, and Tim is also as well. So maybe we can talk about this next Thursday with Tim. But in terms of technical analysis, which is the focus of tonight's webcast, you can see that there's an uptrend line there, but it's accelerated at what I think is a very unstable rate. So you can, there's nothing wrong with having multiple lines. You can draw an uptrend, 20 lines. Whatever, right? The purpose of lines is really just to visually put down on paper what you see, right? Sometimes I can look at charts and I don't need to draw lines, but that's because of experience. But I will still draw my lines. Like if I go to any other chart, like let's say I go to Newcrest. All right, that was a terrible example. I must have deleted my lines, but here I've got our line drawn in. More often than not, I have lines drawn in on particular charts, most charts, right? So there's nothing wrong with having multiple trends is where I was trying to go with that. And this type of rate of acceleration isn't sustainable by any measure. Again, that doesn't mean it's going to fall tomorrow. I suspect it'll have a pullback soon because natural profit taking comes in. But at some point, this trend line, I think, will break in the near future. Will it head back to this trend straight away? Maybe not. Sometimes it doesn't. Sometimes it does. I'm not a wizard. It would be unreasonable for me to even try and give you an opinion on that. But I do know the steepness of this line is not sustainable for a long period of time or even a medium period of time. The only other type of, getting back to the point, right? Now that we've drawn our trend lines in, I can't see any counter trend lines. I would have to zoom out potentially to see if there's any other kind of stuff going on. Because sometimes these stocks have weird days on them. All right. So there's no resistance, right? So this is what you call at blue skies, right? It's at all-time highs, I think. And the all-time high means that there's no resistance to target. So I don't know, excuse me. So I don't know where this is going. I don't know. I haven't got a target for it to get to. It's blue sky, uncharted territory. The next step would be to draw in any support levels. Well, with this type of acceleration, it's really hard to see a support. Like the next support level is this uptrend line. Maybe there's a support level here at this resistance, right? Maybe that will be a target and will coincide with the uptrend line. I don't know, right? It's too hard to tell. It's very far away from the moving averages. The other thing that you can use the moving averages for is overbought and oversold. So from the 200, when it gets to about, well, for most normal stocks, when it gets to about 25 to 30%, it's starting to get to the oversold period. That's good for indexes. For some stock, it can be a lot different, right? And you need to go compare history as to when it does the pullback. The problem with this particular stock and doing technical analysis is that the stock is typically driven by fundamental analysis. So Luther, I would comfortably say that you bought this stock 4 years ago, not because of how it was technically trading. You probably bought this stock because someone told you about it and you perhaps did your research on the fundamentals of the stock. Perhaps you bought into a story. Perhaps your broker recommended it. I would be confident, in saying that it wasn't a technical analysis decision. These particular types of stocks that get a lot of hype behind them are generally traded on the back of exactly that hype, sensationalism, perhaps good fundamentals. I know this carries negative connotation. It's really not meant to, right? My point is that it's not technicals that this stock can often move on, albeit it does stick to some technical factors. So what I do find is that even when stocks can trade technically, let's say it falls on the back of a fundamental piece of analysis, or let's say it goes up on a fundamental piece of analysis, where it stops rising or falling quite often will be a technical level, right? Now, in this particular case, it's blue sky. So there's no technical level for you to target. But if it does fall, you can rely on your technical analysis to give you a pretty solid target of where the stock could stop falling, right? And by the way, this is applicable to cryptocurrencies. This is applicable to Forex or whatever, if you don't look at the Australian market, this type of analysis applicable to any analysis, any instrument. Oh, wait, not instrument, market. I got there. So, that makes it a particularly hard stock to trade technicals on. But again, you could use a the moving averages to determine if it's overbought in the short term. Usually, again, when it gets to 25, 30%, for these smaller caps, it's a much higher number. What you would typically do is you'd go look back in history and go, okay, how far away from the 200-day moving average did it get before it started tracking sideways and falling? In this particular circumstance, it was 160%. In this particular circumstance, it was 100%. Again, what's triggering this, though, is more often than not, it's something a little bit fundamental rather than technical, so it's not that reliable. The stochastics in the short term are very overbought, right? When the stock has gotten to the overbought periods, it usually doesn't hang around here for a long period of time. Is that a fair enough comment? And so I wouldn't expect this stock, again, to go up much higher than it's already gone without having some kind of pullback. Will that pullback be devastating? Not necessarily. But there seems to be a thing where if the stock rallies really aggressively, the pullback can be also very aggressive. And that makes some kind of sense if you think about it emotionally. People have been buying up the stock, buying up the stock, buying up the stock. And as soon as they see a little bit of selling, they go, I better take my profits now. And that can lead to a bit of a snowball effect. Now, I'm not telling you to sell your stock, Luther. I wouldn't do that. I don't know what your circumstances are. Don't even tell me because I can't give you personal advice. But if you are a trader, I would be looking at taking profit soon. Is that fair enough? Now, we've gone already 12 minutes over time, so I hope you guys are okay with that. I'm okay with that. At some point, though, I will need to use the facilities and go have some dinner. But my webcasts have gone much later before. Origin is a little bit easier to do technical analysis on because it's a blue chip company. It's been on our market for years, obviously, and it's very well established. It's a stock that's traded more fundamentally rather than hype or social media-ly, right? And so it's easy to do fundamental analysis, and it's easy to do technical analysis. Fundamentals is easy to do on any stock. Now, when it comes to step one, which is, again, drawing your trend lines and drawing your market range, it's probably best to start out wide if you've never looked at the stock before. Now, I've looked at Origin before, so I don't do this. I don't go and, in fairness, there's also not a great deal of point comparing current day move to what happened even like 5-6 years ago. But what you can do is you can turn it from a daily chart into a monthly chart, let's say. And my Lord, can we just, and that can compress the data a little bit, so that can help when doing a longer term analysis. And you can draw your trend lines in, right? It's up to you. It's not going to help you in the short term because this is where the market is now, and that's where the trend line comes in. But it might give you a rough idea of what the stock's doing broadly, okay, if you're doing, for whatever reason. But really what you want to do is go back to a daily chart, and most of your analysis is going to be done if you're a short-term trader in the short term. Funny how that works. So I know I'm kind of skipping around a little bit, but if I was drawing my trend lines, right, I would draw in this trend line here. It doesn't have to be too perfect. Try not to go through too much price data. And what I mean by that is try not to cut through bars if you can help it. You can a little bit, that's okay, but not too much. Support line, uptrend lines are always underneath the stock. Remember that. Can I duplicate it and define a range? Perhaps, perhaps not. 2 touch points isn't really valid enough. And if you keep that line there, it might affect the way that you trade. So get rid of it. Draw any accelerations. In this case, you can see one here. Right. Now, you know how I was saying before on Brain Chip that accelerations aren't sustainable? They can last for a little bit of time, but eventually they return back to trend. Here, there's plenty of examples. I mean, I can look here. Really big run, and it breaks and returns to trend. Really big run, and it breaks and returns to trend, right? Really big run again. Now, should you go, oh, well, these are the same amount of distances? Maybe, right? It's something to keep in mind. Would it stop me from doing a trade? Probably not. But that's fine. Well, medium to long-term trading is hard to define, Karen, because now you're starting to get into investing. And that's not what this webcast is about. When you're investing, technical analysis is good for your timing, but fundamental analysis is the crutch that you need to lean on, right? Luther invested in BrainChip 4 years ago, and he's been rewarded, but the majority of his analysis is around fundamentals, he confirmed. Fundamental analysis can help shape what you're doing in the short term, but it's technical analysis that you should rely on. When it comes to medium to longer term, fundamentals are going to rely on a lot more. I know that's not really answering your question, but that's all I got for you for today anyway. All right, so maybe you can draw a little bit of a market range here, right? Anyway, I'm getting sidetracked. It's getting late at night. I'm starting to slow down a bit. So there's only so much that a bloke can talk to himself, right? I know you guys are listening, but I'm the only one talking. So the acceleration, you could even go, oh, okay, maybe there's even a really shorter term one here. That's a little bit pedantic. I don't draw that in. But I certainly recognize that it's move away even from the acceleration. Now, I find once a stock accelerates 3 or 4 times, it's ready to break. And it's ready to break lower because profit taking will come in. Again, things that move up really quickly aren't sustainable. And so they come crashing down. Okay, crashing down sometimes, but they often come off at some point, whether it be just for reprieve, whether it be for some small stock taking or whatever it is, right? Profit taking. With Origin, now that I've drawn my uptrend lines, I've got my resistance there. You can see it broke. So you're late to the party, to be honest, Karen. The next level of resistance, I actually have to go back a little bit further to see where it is. I'm probably going to draw it here. You can see, if I just zoom in there, and I'm trying to be aware that not everyone has great eyesight. You can see for a good period of time, it tracked along and it really didn't want to break it, right? So, I mean, it was a bit of a different period of time there, but that's kind of the best we've got. So the question is, for a short-term trade, can you make money from where it is now up to that line? With strategies that we can teach you, you can, right? But you could take perhaps a more conservative approach and do perhaps where you need to make money up to $6.20, right? It's horses for courses. It depends what style of trading you're into. There's only so much I can teach tonight, all right? So once you've defined where you think the stock could be going, you've picked some targets. The next step is to identify, to look at your stochastics, right? So again, in the context of what we're doing tonight, it's about going through a process. The final step, entry signal wise, it's pretty good. The problem is that for me, it's gone too hard, right? I'm not going to get too stuck into that, but I wouldn't be getting into this today. I would wait for a better entry signal. It is also looking very overbought. So if you were aggressive in the short term, or if you were doing perhaps a longer term kind of view, perhaps a medium term view, then you could probably justify it. In the short term though, and you're trying to be a little bit more balanced approach or a little bit more conservative, I'd probably stay away from this. It's not that I think it's bad. It's just that I think there's probably other trades out there that are better. Do you know what I mean? Again, no one's forcing me to trade. I don't have a gun put to my head. There's 200 stocks that I could look at. I did a trade yesterday. I don't have to trade today. I could trade tomorrow. If I miss out on a trade, so what? Do you know what I mean? So for this, there's enough red flags that I would just go, I'm just going to move on. Is that fair enough? I'm not even going to get into the fundamentals of Origin. PLS, which one's this again? Bar, yeah, okay. Again, so when it comes to these types of mining stocks particularly, and I hope I haven't just made a fool of myself, right? There's a lot of stuff rattling around in my brain. Quite often you do, especially some of these smaller stocks, you want to look at the fundamentals. And a lot of the time they do end up being hype stocks. Again, there's nothing wrong with that, by the way. It's just not my form of analysis. And that's not to say it shouldn't be yours, because plenty of people make money off that stuff. It's totally legitimate. I actually don't mind how you make money. All I care about is you make money. If you make money by turning 3 times, standing on one leg, hopping, reading the star signs, if you make money in some weird way, good on you. All right, so PLS, even just whilst I was rambling, I was drawing lines, right? So I do this subconsciously now. I drew the uptrend line in, I drew the acceleration in, I drew another acceleration in, right? This one looks a little bit less sustainable than the others, but I think it could last a bit longer. You can see that it was channeling, right? It didn't want to break above roughly $4, and it didn't want to go roughly below 340, right? What you call consolidated, and it consolidated into the trend line and bounced. Today, it broke through. So this is actually what I would call a decent entry signal. The problem is that the stochastics are pointing down a little bit and they're in the overbought area. It wouldn't stop me from doing a trade. And again, like I said, I do this at the end of my analysis for this exact reason, right? The other thing to keep in mind that it's moved away from the 50 quite a lot. And when it moved in the past, when it got to about 56% above the 50 or whatever, did I say 56? I meant 46. So you can round that down to 45. Right now it's trading about 4%. So maybe there is a bit more room to go. Doing one thing is not enough of a sample in order to judge it. I'm just doing this fairly quickly. That was 68%. I'm doing this fairly quickly. So you would want to confirm with your indicators, but yeah, I don't mind this. I don't mind the look of it. Tomorrow, if it hasn't gone too hard, this might be worth a buy. I would look at the fundamentals. I pretty much frame that. But why don't we look at these again next Thursday? All right. So I would leave BRN alone. I have a feeling it'll pull back soon. It'll be interesting to see if it pulls back by next Thursday, won't it? Origin had, I think, too many red flags for me to justify a trade right now. But PLS, on the other hand, I think if you're a little bit more aggressive and you bought a mini long on it, or you just bought a parcel of shares, I think this could be worth a bit of a buy in the short term. But only in the short term, because I think this is going to pull back. And I think if you're going to buy it from medium to longer term, you could time your investment a lot better, I think. Yeah. But if you had a bit of FOMO and you like the fundamentals and you wanted to get in today, I'd totally support that. So if a client called me up and said, hey, PLS looks really good fundamentally, what do you think about the technicals? I'd support their decision to get in. Yeah. Again, no easy answers with me, no short answers with me. All right. So it's starting to get to that time where I really should be wrapping up. I just want to quickly run through these slides, if you'll forgive me. Again, this webcast is for beginners, and I want to give you a bit of a guide. You're absolutely welcome, Karen. A lot of you are kind of in this step, maybe not, all of you, but some of you are in this step where you don't know what to do, like that dude's saying, and you're leaning down, you're reading, you're doing lots of study, which is great, and I encourage you to keep studying. There's never an argument against learning something, is there really? Except for I don't want to, which is totally legit. But the next step is to get some education, to practice, and then implement, right? That's the process at the end of the day. Research, learn, implement, right? In terms of the learning part, as I said to you earlier, it's probably good to get some solid education and or have a mentor. Don't forego both those things. Preferably have both. Obviously, your time commitment and your financial circumstance might dictate whether or not you can do that. But if you're not in a financial circumstance to pay for a course or have a mentor, you're probably not in a financial circumstance to short-term trade. Now, if you're looking just to buy some stock and build a portfolio, then that's awesome. I think everyone should do that, but that's not what we're here for, okay? So if you are wanting to learn how to trade properly, and you want to learn to generate an income stream, your goals are intrinsically higher risk than simply buying stock. And that makes sense, doesn't it? I'll give you a quick example, and it's an analogy I love. If you wanted to get from if you wanted to get from A to B, you could walk it. And you learn to walk at a very early age, theoretically. And if you can't walk for whatever reason, then I apologize for this analogy. But forgive me. To get to A to B, you could walk, right? It'd be very slow, but it'd be fairly safe, right? You might fall over and you scrape your knee a little bit, but it's not a life and death scenario walking from A to B. You could alternatively drive a car there, right? And that's going to get you there much quicker. But that is a life and death scenario in many ways, because if you do 80 kilometers down the highway, or you do 60 kilometers down a road, and you hit a car or you hit a tree or something like that, I know this is very grim, but you know, that can cause a lot of pain and perhaps worse. The thing is that we are happy to take that risk of getting to our destination quicker because we know what we're doing, right? They don't just hand you keys and then off you go, right? No, they make you take a test. They make you take a theoretical test to make sure you know the road rules. They then give you an instructor. Sometimes maybe it's your mom or your dad, and they sit next to you and they hold your hand figuratively, because theoretically you should be on 10 and 2. And they take you to a parking lot and they help you practice off the road or to some like field or something like that. And it's only once you've kind of gotten that down are you actually allowed on the road and do you feel comfortable perhaps driving. And even then, you might not do some mad road trip where you're driving for 12 hours. You know what I mean? So I think trading is the same thing. If you want to get from A to B via walking, then buying stock is good. And I think everyone should buy stock or a house or some investment, right? I mean, your super does it for you anyway, whether you like it or not, probably. If you're with an industry super anyway. But trading is basically driving a car, and it can get you to where you want to be a lot quicker, but it's just intrinsically higher risk. And if you don't know what you're doing, it is damaging. It could be damaging, right? So if you are interested in trading, please go get a proper education. And if you're not going to do that and you want to self-educate, that's fine. Just make sure you have a mentor that you can bounce trade ideas off. Now, I'm not going to talk about our education courses tonight. I'll talk about them next Thursday. But obviously, we do run a course for beginners, and we run one for advanced people who want to learn options. We're not a company that keeps upselling you and upselling you and upselling you and upselling you into courses. We don't make money from our courses. Our courses are a stepping stone to you trading with us, because our company is built on retention, not acquisition. We run very small courses. We run them sparsely. And we want to give you as much individual focus, because what keeps our doors open is you trading through us. And if we help you make money, then you're likely to continue to remain a client, right? And that's what we that's what we care about. So we run a couple of different courses. One of them is for beginners, and the other one is for options trading. If you're interested in learning to trade, come along. The idea is to teach you all those things that we've learned tonight, and we cover trading rules, give you a set of trading rules to follow, okay? If you don't want to learn to trade because you're already a trader, but you just want like a mentor, you want someone to bounce trading ideas off, or you want some trading ideas, you can just sign up for a trading account. You can just open up a trading account with us, build a relationship with us, and get some support, really. We can give you some advice on picking direction, technical analysis, fundamental analysis. We can give you advice on strategy. We can help you manage your risk. We can give you, trade ideas, all that type of stuff. If we don't feel like you know what you're doing, though, we'll insist that you do some education. Is that fair enough? What really makes us different? Is that we want to focus on you on as an individual as much as possible. We really want to give you the best support that we can give you, because again, it's about mutual success, and we don't work on individual broker commissions. So if you trade through me or Sam or Tim or whatever it is, if you trade through me, I don't get paid more money. It doesn't affect my paycheck whether or not you trade. So the problem with other brokers, in my opinion, is there's a conflict of interest. It's actually within their interest to give you advice that gets you to trade. There's some interest for us to get you to trade as well, but not me personally. It doesn't affect my personal paycheck. I get paid no matter what. You know what I mean? So that's a point of difference as well. Now, the next webcast is the 20th of Jan. And if you are interested in our beginners course, we are running one on the 5th of Feb. Obviously, with COVID, you can do a live stream. So if you're interstate, or if you're in Victoria or Melbourne, or wherever you are, if you feel perhaps more comfortable staying at home and doing the live stream, you're welcome to. It's 2 full days, 5th and 6th. It's fairly intensive. And if you do want to come into the office, you can, provide the government lets you. We just do it in our boardroom. So you get to come in, I'll be here, obviously. You can say hello to me, have a look at the office around you and or around me, and say hello to the other advisors as well. All right. So if there's any other questions, type them in now, or hold your peace until at least next Thursday. But otherwise, I'm going to log off for now. If I speak to some of you before then, great, but not in Brisbane, no. But you can do the live stream in Brisbane if you want to. You're welcome to. Just let us know. Register your interest. If you'd like to receive some more information on the course, just type info. Oh, there's a fee. Yeah. There is a fee. I usually don't like to tell people the investment of the course, because at the same time, I can't tell you all the value that you get with it, right? I don't like telling the price of something unless I can tell you what's involved, because then all you're going to do is focus on the investment. It's a psychology thing, to be brutally honest. But essentially, it's just under $2,000, right? And hopefully you feel comfortable tonight that, you know, the type of learning that you're going to be doing is very rigorous, and, you know, we give you lots of support, but it includes 2 days face-to-face, and there is a lot of online resources. We run webcasts every day when the market's open for our clients. We give you trade recommendations, reporting calendars, calculators, all the technology. I mean, there's a lot of stuff involved for that. So if you're interested in that, if you'd like some information, just type info. If you'd like to have a chat to us, type chat. Just let us know. Happy to. Equally, if anything that I've run through tonight that you just want a bit of clarification on, you're welcome to give me a call, have a chat. Chances are I'll pick up the phone anyway. Like I said, we're a small business, and yeah, happy to have the convo. All right, guys. Thank you very much for taking the time out of your night. I really, honestly do appreciate it. I know these kind of long form discussions can be hard to take priority when it's been a long day. You know, I really do genuinely appreciate you guys taking the time to listen to what I have to say, learn a couple of things. It's good fun for me. You can tell, hopefully you can tell I enjoy it too. Like, it's a big passion of mine, and it's good to be able to share it. All right, let's finish up there, and hopefully I'll see you all on next Thursday, the 20th. Bye for now.